Welcome to Investors Insights. Our topic today, volatility, China, and jobs. Yes, you heard me correctly. We've had a great meeting with a lot of debate and discussion, and I'm excited to ask Bobby Norman, Ty Miller, and Trey Booth to join me as we share what was discussed in our meeting. Our portfolio strategies meeting goes into a lot of detail, a lot of research. We subscribe to a lot of research. Hopefully in these meetings and this vlog, you see the quality of information and research that we look at. That said, Bobby, start us off. You talked about the month of October, volatility. Elaborate on that.
Yeah, we've got a busy week with important reports coming out on the economy. And we're also starting the month of October, which has historically been volatile in election years. The good news is September, which is historically the worst performing month of the year, has been surprisingly strong with the market liking the Fed's big rate cut. But volatility is expected between now and Election Day, November 5th. So you can see in this first chart, it shows the volatility index on a monthly basis that October is historically the most volatile. But as you can see that when the election is over in November, the volatility falls significantly. So while it wouldn't be surprising at all to see market volatility spike in October, any market pullbacks could be viewed as a potential buying opportunity because of what happens next. And so looking at this next chart here, leading up to the election, markets tend to be lower. But following the conclusion of the election, including the composition of the White House and Congress, markets historically gain momentum as positive seasonality unfolds here. The chart also shows that we historically see a market bottom in October followed by a post-election rally. So we'll be watching the market action carefully leading up to the election. And it's important to know that volatility in October is historically normal and rarely validates a big strategy adjustment because of what we see after the election.
Yeah, and Bobby, I really appreciate your insight. Hey, folks, let me say this. Bobby talked about the month of October. He talked about Election Day. Let me also say it was discussed in our meeting that tomorrow is October 1st. Think about it. In 90 days, we will be celebrating the year 2025. This information that we're providing you in this blog, there's a lot of things going on, and we want you to be able to see how things are coming together as we finish up the 2024 year. Trey, you talked about China. I thought that was great research as well. Bobby, can't thank you enough. Trey, what you've done this morning on China, great insight about the movement of the Fed in relation to China. Nobody thinks about that. Elaborate on that.
Yeah, absolutely. So last week, the Chinese Communist Party announced massive stimulus towards their markets. Now, the Chinese have announced stimulus over the last few years multiple times, but really hasn't had much impact on the market. So why is this different? Well, this time they're pointing it specifically at their stock market and their public equities. They're allowing individuals to borrow to buy stock. They're allowing companies to buy back stock, which they previously were not allowed to do so. But one of the questions is, okay, if you look at this chart, here's the Chinese stock market over the last 3 years. It's been going nothing but down for years. So why now? Well, the reason is because the Fed cut rates. And to your point, Greg, a lot of people may hear the Fed cuts rates, China stimulus. How are you connecting those dots? Well, one of the things that held the Chinese back from really their bazooka level stimulus they announced last week was that when a government stimulates its economy, it prints money that weakens the value of their currency. What the U.S. did when we cut interest rates by 50 basis points instead of the expected 25, that weakened the U.S. dollar. And that gave China some leeway to weaken their currency as well without getting too weak, because the dollar comes down. Now China can weaken their currency a little bit. And it's all relative. And so that allowed China to really boost their stimulus. And you can see it in this chart. The Chinese stock market in a few days up 20%. That's the second largest economy. Stock market's up 20% in a couple of days. That is a massive stimulus. Now, where does that go from here? It will impact the Asian markets first, then the European market, and then us. But it's definitely going to impact our stock market when you have that much money, billions and billions, potentially trillions of dollars, just being flushed into equities across the world from governments. That's going to put upward pressure. The risk is, though, are you running too hot? Right now, everyone loves it. Free money, people like it. But we know the downside of running too hot, that causes inflation. And where that will hit first is in Japan, which is the closest developed economy to China. We saw what happened when the Japanese stock market got too hot back in August. We had what's called the reversal of the yen carry trade. Our stock market went down 10% in a couple of days. The Japanese stock market went down 20+%. So it's not a one-to-one, but there is some risk. So this is going to be good, but like all good things, it can't go forever, and it's going to have a hangover. And what's going to stop it is that yen carry trade, where the Japanese may have to raise their interest rates to slow their economy down. So a lot of moving parts. Talking about really quickly here, but it's having direct impact, and we only have a few months before the end of the year. So this move is massive, and what's oddly enough, it all started with the Fed.
Well said. People have no idea. And, a lot of times with the Fed, everybody's focused just on our economy, but there's that huge rippling effect that you've just described. But I also want to bring us back home because, Ty, you talked about the Fed also this morning, and the big concern is unemployment and jobs here in our country. As we got some announcements coming up. So talk about that rippling effect as well.
Yeah, so we obviously have a big jobs report coming up later this week. It's important because we saw last month, July's unemployment was 4.3%, and in August went down to 4.2%. And so, you had that decline, but kind of you want to see if that, stays intact or if we go back up. And so one thing that the Fed did, of course, was cut interest rates by 50 basis points. And the Fed's primary goals are to keep an eye on inflation and then to keep an eye on unemployment. And so with inflation seeming to be under control for the time being, a lot of fear is that did they do the 50 basis point cut because they know something that we don't in the job market? Are they saying that we're going to have a weaker job market going forward? If you look back, January of this year, we started at 3.7% unemployment. We rose in February, dipped in March, and so we kind of followed that, one up, one down trend. But then we went up for 4 consecutive months after that before dipping here in August. And so that's something that we surely want to keep an eye on to see, is that upward trend going to continue? Was last month just a blip, or are we going to kind of get a grasp on this unemployment situation and have it under control? If you look back historically, unemployment moves in trends. If it's going up, there is a month or two where maybe it'll go back down, but historically it continues to go up. And when unemployment is going down, it continues to go down. Usually, like I said, there's a month or two where it may break trend, but that trend usually holds. And as unemployment goes up, that typically leads to a recession. And so it's certainly something that we want to keep an eye on going forward. Not only this jobs report will be a huge one, but the ones, from now to the end of the year going into next year, you're really going to want to keep an eye on those going forward, because that's how the Fed is making their decisions right now, as opposed to the past couple of years where it's been inflation driven.
Folks, you can see there's a lot of moving parts here, and we're watching those moving parts to see how they come together. I had a blast with a conversation with a client of ours who said, Greg, I always pick a couple of the topics in your blog, and I love to take it on a Saturday to my tailgate and throw those topics out, which I thought was funny. Normally, everybody's talking about football season and about the team and everything. And I said, well, that's a huge compliment, because I will quote Trey Booth. We have a sleeve of information that we are very, very good on. But when it comes to parties, we're not that entertaining. So it meant a lot to me that a client took information from our blogs and actually talked about it at a tailgate. So, folks, we hope you're sharing this information. Share these blogs. We hope you send it to family, friends, and colleagues. We also hope you're taking advantage of all the technology we use, like the blog, the social media, Facebook, Twitter, LinkedIn, YouTube, our podcast. We've got more and more things that we're excited about to bring you information, because one thing we don't want you to have is anxiety or worry as we go into October with volatility. We hope you have a great week, and know every day here at Five Plan Partners, we're striving to see to it that each of our clients has a better, richer, fuller life. We thank you and appreciate your trust, confidence, and support in those of us at Five Plan Partners. Take care.